Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as usual. Guys, the Fed and the Treasury are going bananas. The debt is skyrocketing. What's going to happen? We think it's going to leave a mark. We're going to tell you about it. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, Bob. So these guys are acting like, drunken sailors in the saloon. What do you think?
I don't know, Phil. I'm thinking, saying what really is the game plan here? Because we've been leveling down for decades here in terms of, interest costs. And now this next is going to be a massive step up. We're at $1.2 trillion in annualized interest payments now.
Crazy.
I mean, 20 years ago, that was our budget. And with the new stepped up, average value here going into 2025, we're going to be at $2 trillion interest payments. I mean, we're stacking new loans just to pay the increased interest debt. And I think it's going to be an absolute disaster in the making. So I sit there and say, okay, well, what does that really mean to me? So while they continue to do this, they're really increasing the money supply. That means who's getting this money right now? So you think about it, pension funds, right? Some foreign governments, insurance companies are getting the money. And maybe that's the plan. Maybe they're just trying to liquefy these entities here before they turn around and start cutting rates again so that they don't destroy them. But in the meantime, if this money starts leaking out because people are starting to spend it in retirement or whatever, it's just going to keep raising the cost of goods and services. And I think we're going to get on a wheel here that we can't get off. What do you think?
Yeah, it's an interesting spot because we have a situation where we have trillions, right, sitting in money market funds, right? So if your interest rates are at 4 and 5%, you're actually creating an inflation because all of that money is now being paid out to all of these money market funds that are just sitting there collecting, essentially risk-free returns. So it's weird because, on one hand, they're saying, well, we got to raise rates because of inflation. But then at the same time, it's inflationary because of all the yield that they have to pay out. And it's actually creating more of a divide between the have and the have-nots. Because if you don't have a ton of money that you're able to yield up from, then you're basically being cut out of the entire loop. So is it very healthy right now? No, I don't think it's very healthy at all. And I think that ultimately the Fed will have to cut rates because I think we're going to see this thing start to roll over here. So I think if I'm reading things correctly, the Fed is kind of telegraphing to us that, hey, rates are coming, but for all the wrong reasons. But they're going to be able to say, hey, look, we told you guys rates were coming down. And I think they're okay with that because I really do think that the only way out of this inflation trap is going to have to be some sort of correction in the economy with a recession, which, as we've talked about, we're probably about 2 recessions overdue. If you look at the average time span between recessions, it's 5 to 6 years. And we're going on 13 years now without one. So, maybe we're going to get a twofer.
Well, it's just kind of scary. The good news is that when the Fed pivots, we definitely just move into TLT because that's really going to be the play. And maybe that's what they're going to telegraph to all these pension funds out there and saying, hey, start locking in these longer term duration because we're gonna start driving the new rates down to zero.
Right.
Look, eventually they're going to have to do negative rates one way, shape, or form. Either it's going to be purely negative or they're going to create this positive environment where you have rates at zero and then slight inflation, which is going to be just good for basically commodities. And commodities and TLT is going to be probably the only trade that's going to be out there. We start bombing this thing back to zero. And TLT, if we go from 5% or 4.5% now to basically back down to the zero bound, you're looking at TLT going from 93 to probably 153. So it's going to be a beautiful trade. And the stock market, as we've shown you over and over and over and over and over again, is that it doesn't like falling rates. It's so counterintuitive, it makes your head scratch. When they're raising rates, you think, hey, we better get out of we better get out of the market because the Fed's raising rates are going to kill us. But what we found out is that they basically depends on the mix of the debt instruments. And now when they start lowering rates, you know, are we going to have the same situation again, or is it just going to be across the board? Better get out of equities and get back into bonds. So it's going to be fun to watch. And Phil, speaking of TLT, you threw a chart up here. Why don't you throw it to the group here and explain it? Because this is what I'm talking about. This is the trade.
Yeah, so this is a ratio chart, right? TLT into SPX. So if TLT starts cranking up, then these candlesticks are going to start jumping up here rather quickly. Now, we've had various times where, you know, I've got our Heat Pro indicator on here, and it shows you kind of when the oscillation bottoms out and it's time to crank up. And that's really where you want to be careful because, you know, hey, why would the bond market potentially be cranking up against equities? And you can see that there are periods of times when we get these signals that the equity market in orange here takes a hit, right? What we have to really compare this to, though, I think is back in 2007 going into 2008, we had one of our signals fire off, and that's where TLT really started to go up against the S&P 500, and the S&P 500 itself started to really take a nosedive, and then we went into our 08 and 09 timeframe, which wasn't very pretty. If we fast forward to where we are today, though, look at how much of basically we're getting a big buy signal here for this trade. So I would say you got to wait for like this trend line to start breaking and this to confirm to start turning up, and then we're probably going to see the S&P 500 start to roll over. And I mean, you know, that's going to be everything else too, probably commodities and Bitcoin and gold will all start to roll over. We're not there yet, and this can continue on. Like, you know, as you can see back here, we were getting, you know, you didn't really have the full-on trend line break, and the markets kept grinding higher before rolling over. This is a little different. We did not have recession here, and the yield curve started to go inverted versus 2007, where we were coming from a point of inversion and coming up into a bear steepener. And similar, I think, what's going to happen here. And so that's why I think this signal that we're getting now is actually going to be the one that really starts to crank up. 2007 over here. And then you get this extreme, I think we're going to see a very similar move in terms of TLT to SPX cranking up here. And you're going to want to be long TLT when this happens. So I think we're getting close.
Yeah. And Phil, our customers get the heat indicator, do they not?
Yeah, that's on this website, the Heat Pro. It's a better oscillator than other things like RSI and things like that. It's a little smarter.
Yeah, less false positives. Guys, you can get this indicator, you can get our Worm, you can get our Ranger. It's all you need to trade effectively. So check us out, tradelikeagenius.com. We got specials running to the end of the month. I think you'll enjoy them. And this market is getting really fun. We've now really been pounding it. Phil, we had another client that put a note out today saying that they were able to retire based on being with Trade Genius. It's pretty gratifying, don't you think?
Yeah, it makes it worthwhile.
All right, guys, we'll catch you later. We'll see you tomorrow.
Trade Genius.